All right. Well, it looks like everybody's filing in here. We're going to get going. Before I start, we will have a Q&A after the workshop. So if you have any questions, there should be a chat box that's called Q&A. So if you could put your questions in that box, I promise that Tim and I will try to get to it. So like to get started. Thank you for attending our 2025 Market Outlook. My name is Brandon Ross. I'm the co-CEO of Quotient Wealth Partners. I have my co-founder and CIO, Tim Harder, with us. Today, we're going to discuss a little bit on what's happening in the markets. We'll do a little bit of a review of last year. I know everybody wants to talk about tariffs, so we'll talk about tariffs and talk a little bit about the Mag 7 or Magnificent 7 and how to invest in today's world. Hey, Tim, how are you doing?
Great. Thanks a lot, Brandon. Good to get this year going here. We're already into February, so exciting.
Let's start a little bit, Tim, if we could, and look at the 2024 asset classes. This slide is a little confusing, but this is basically how every single major asset class performed last year. And tell us a little bit on what happened and how the markets did.
Yeah. So yeah, it's great. Thanks, Brandon. So last year, obviously, I think the headline, that's that purple line of all of these confusing lines that run across the screen there. But that's the S&P 500, and we know we had a really phenomenal year. This is back-to-back 20+% years here in the market, in the U.S. markets anyway, large cap markets. So 25%, really a phenomenal return. I'm just going to go out on a limb here and just say don't count on that for 2025. We love it when we get those, but we don't want to count on those types of returns. I think the sort of the underlying story underneath of that, and one of the questions we often get is, oh, that was great. Why don't we just invest in that? But I did want to kind of point out that last year, if it weren't for the phenomenal success of the S&P 500 last year, doing 25%, the rest of the markets actually returned pretty well last year. If you're kind of looking down here, the orange line is small cap, and I think a lot of people have forgotten about small cap, but this is the second straight year of double-digit returns for small cap. Did 11.5%. Now, it was a very bumpy ride. If you can follow that orange line, a lot of ups and downs there, and it really returned most of that in just a couple of short spurts throughout the year, followed by giving a lot of it back and then regaining it again very quickly. But that was a small cap story. I think the other part that folks are looking at when they're thinking about outside of large cap U.S. Is sort of what has foreign done. And I think a lot of folks, not a whole lot recently, or not a whole lot maybe for the last decade or so. But what we're looking at here is the MSCI EAFE, which kind of broadly represents developed international markets at 4.34%. And I think a lot of people are kind of down on that. But what I want to point out here is this green line up here, the 13.72 is actually, that's the ETF. The index itself did a little bit better at like 14.1, but that represents the currency hedged international. So it's the exact same investments, but without the foreign currency fluctuations involved with it. And part of the reason that the returns have lagged so badly is just the strength of the U.S. dollar. Those foreign markets in their local currencies did about 14% last year. And so, as many of you know, when we're allocating assets, we're always looking at that and saying, hey, we don't know if it's going to be a strong dollar or a weak dollar year. And we really try to keep a good balance between what is hedged and what is unhedged. And so if you're thinking about that, thinking about half at 14 and half at 4, kind of averages out to 9, which actually is a pretty good year for international returns. So I think all in all, if you got about 9% from your combination of your hedged, unhedged international, 13% or 11% from small cap, and then, of course, love the 25% from S&P 500, which tends to be our largest core holdings in most portfolios. It was overall a pretty good year. The one big laggard really was the bonds, which had barely positive returns, a little over 1% this past year. But But all in all, when you added it all up, just a broad 60-40 allocation between stocks and bonds, global index, and averaged out to about 10. By adding in the small cap and hedged international equity and maybe underweighting international a little bit, which is all of those things that we do, those returns were able to get a little closer to 12 to 13 in a 60-40 portfolio.
Yeah, definitely easier when the market does well like it has, and obviously the U.S. large caps or the S&P 500 has done phenomenal not only last year but in 2024. Had really great performance, driven primarily by technology and AI stocks. And the question that I receive and a lot of our advisors receive is, why don't we have more of that? So tell me, Tim, why would we put money into international and small cap stocks?
Right. Why do we? Yeah. Why don't we just invest in the S&P 500? And keep in mind, phenomenal returns. And if we get the next 2 years turn out to be exactly like the last 2 years, that will be a great strategy. However, that's not always the way it works out. And so when we're looking out at this space, and particularly with the backdrop of what you talked about, sort of this drive from just a handful of technology stocks, especially around the artificial intelligence space, one of the big risks is that there's a misstep there, and how do you protect yourself against that? So when we're looking at this, you can see the solid bars as they go up. Those are the expected earnings growth percentage rates this coming year. So for the U.S. large caps or the S&P 500, there's an expectation that earnings are going to grow up 14. And that the valuations, and so this is really important, valuations, these are price to earnings multiples, is forward looking. So with the expectation that earnings are going to grow by 14%, the market is willing to pay 22 times the amount of earnings at the end of the year for that. And so that's a pretty healthy multiple, historically very, very high. And so that's one of the risks right there. So what you want to be looking for is, are there places that you can be going that you might either be sacrificing a little bit of the earnings growth, but maybe be able to do it with a better valuation? We just talked about small cap having a pretty good run the last 2 years. Expected earnings growth on small cap is a little bit higher actually than the U.S. large cap. And the multiple is not 22, it's 16.7. So a little bit better valuations. And if you look across developed, this is foreign, non-US, and Europe, Japan emerging, kind of broken down a little bit more. But you can see that these multiples 14, pretty much in the 14s compared to 22. So they've got about 2/3 of the valuation. So you're not having to pay such a dear price for those earnings as you go. And so what does that give you? It gives you one, protection against maybe a misstep in the U.S. market for sure, but also it gives you a little bit more of a safety net. There's not quite as far to fall as we look at it.
Right. And for layman's terms, looking at multiples, historically, what has been the average multiple for the U.S. stock market?
Yeah, I like on a forward earnings basis, it's going to be long term. When I got into the business, it was 15, Brandon.
Okay.
And that's really where you sit. And I don't have this chart up here, and we'd be happy to share it with people later, I think, at some point too. But right now we are historically in the top decile, meaning the top 10% all time of valuations on the market. So they're up there right now in terms of valuation. Now, again, we don't historically have 20% earnings growth expectations either. So, they go hand in hand with each other. It's not that it's just out of nowhere that people are coming up with these stretch valuations. It's literally a function that there's an expectation that earnings will continue at a very, very high rate. And I know we got a lot of people that work the corporate world for a long time, and 20% compounded earnings growth rates are difficult to achieve.
Yeah, they're
especially
tough.
broadly across the entire market. That's a healthy expectation.
Absolutely. And so let's take a deeper dive, into the U.S. stock market. This shows all of the major sectors in the S&P 500. Not surprisingly, technology is the number one as far as earnings growth and the multiple that we just discussed. But talk a little bit of what you see in the U.S. market right now.
Yeah. So it's hard to have any of these conversations without focusing on technology. That you talked about, that 29 multiple. So if the overall market's at 22, technology is pulling that up at 29, 21% growth rates from technology expected for earnings growth this year. But what you can see is there's a lot of places to go outside of technology, so that don't have that 29 multiple. The next highest sector, the next highest sector is industrials, about 23, but a lot of these are in the teens, a little bit more comparable to where you would see where we were looking in the foreign markets as an example, right? So in that 14 range, they're a little bit higher, a little bit more stretched here in the US across the board. But again, it's really strong earnings expectations. The key for us really in this space is just making sure that we want to get diversification outside of just technology. The challenge for technology, when you have these high valuations, there's a couple of things that can go wrong. And I'm always looking at what are the risk factors. One of the things that can go wrong is that they can miss their expectations. So we saw a little bit of some vulnerability for the first time in this whole AI thing just last week with the DeepSeek announcement. And all of a sudden, people became suddenly aware that, hey, maybe it's not just these 7 companies in the US that can do what they're doing. And so we need to be maybe on the lookout. Are there opportunities outside of those in the other 493 stocks in the S&P 500, in the rest, maybe in the small cap space, maybe internationally, right? That was not a US company that made that announcement. So it's going to be very important that we maintain that diversification as we go through this. And it won't always be AI driving things. It might be a long-term sort of secular drive for the markets, but it could be things like healthcare that has also got a lot of earnings growth expectations and much lower multiples that benefit tremendously from like AI innovation. So we want to be very careful to not get too narrow in what we're doing.
Yeah, absolutely. And if someone approached you right now as far as structuring a portfolio and looking at all these different sectors, I mean, what would be the advice that you would give?
Yeah, so and this is the way we're looking at it too, is we want to make sure that we're getting more value into our portfolios. We are really growth heavy today, and that's just the natural outgrowth of these stocks. This handful of stocks doing phenomenally well, but it's kind of tilted us in a way that maybe traditionally we haven't been. We've had a much more of a balance between companies that pay dividends and have really consistent earnings levels, maybe not the higher earnings growth levels that we're seeing from the technology stocks, but we tended to have a little bit more balance historically. And if we get into a higher interest rate environment that could be caused by higher inflation rates, that's also really damaging to these companies that have the expectation that the earnings are coming in the future. Sure. A company with consistent earnings is not going to be hurt as much by higher rates.
And looking at the market today, we have something that's unprecedented. This is the top 10 holdings in the S&P 500. They actually account for almost 36% of the overall market. That's a lot of concentrated weighting. We talked a little bit about the Mag 7, how that's driven the market. How would you go about discussing this concentrated weighting and some of the risk associated with it?
Yeah. So this is the biggest challenge we face today, right? We want to participate in those earnings. We have equal number of conversations with, do I have too much of this? And can I have more of this? The challenge for anybody that wants more is it's really hard, because when you're looking at the top holdings here, Apple, Microsoft, NVIDIA, all at 6% or higher of the index. And this lists the top 10 companies, but it's really the top 9 because Alphabet, Google has 2 share classes. And it's really unprecedented that we have 36% of the S&P concentrated in just so few, the top 10 holdings. That's really unprecedented. Typically, you're going to see those numbers more around 20. About 2% allocations is what we've seen historically. So everything that we're doing is saying, hey, can we participate in this growth without sacrificing or taking on too much risk? And so, for people that have the reverse concern, the FOMO concern is, you can take a look here, you're not missing out, right? The S&P 500 is typically going to be the largest holding, or S&P 500 like large cap core holdings are going to be the largest holdings in your portfolio. The U.S. market is 2/3 of the global markets, the publicly traded markets today. So, you've got 7 companies that are 7 companies that are basically 35% of the market, and that's 35% of 2/3 of the whole entire global publicly traded stocks. So it's a really big concentration, and there are other opportunities out there. And I think one of the key lessons, and Brandon, if you don't mind, I'm just going to flip to one of those lessons here, is diversification is important for a couple of reasons. One is the risk that something goes bad and if you're too highly concentrated. But the other risk is that you're not exposed to things that you don't know are going to do extremely well. So this is the S&P 500 30 years ago, Brandon, and what's the top 10 total there?
17%. So
yeah,
we talked about that a little today. I mean, what always happens is times do change. They always have and always will. And we were looking at these stocks earlier today, and what we did notice is that most of them are tilted in a different type of investment style. So you can discuss a little bit about that, Tim.
Yeah, I mean, look at this. This is 30 years ago. General Electric sitting at the top. If you went out and you just picked up a How to Be a Successful in Business book, it would have Jack Welch on the cover of it. And, these are what we would traditionally call blue chip. These are as blue chip comes. And I think most of us grew up as investors in the 80s, 90s, 2000s, and I know there's many people on here that work for these companies too for a long time too, and they've done tremendous things, but they have a very different style. They paid dividends. They, grew consistently and probably less on a hockey stick type of shape of growth trajectories. But one of the key lessons for us as investors, and this is one of the things, because I'm always thinking not just about today, this year, next month, whatever it is. I'm really thinking for all of our clients, they need to make sure that their money's going to last throughout retirement, 30 years. How do you think about investing 30 years in the future? Well, here we are. We're 30 years ago. This is the top 10 holdings in the S&P 500. So if you're invested in the S&P 500 30 years ago, and you did nothing, you just stayed invested in the S&P 500. Did you know that there was going to be the internet in 94, or it would be as big as it was? Would you know we were going to go through a global financial crisis? Did you know that AI was going to be a thing, or COVID? No, you wouldn't have known any of that. And yet you did nothing, and all of a sudden you own that one investment, and then boom, 30 years later, it goes from being GE, AT&T, Exxon, Coke, Royal Dutch, Philip Morris, Walmart, to Apple, Microsoft, NVIDIA, Amazon, Facebook, Google, right? And you did absolutely nothing. And so that's one of the beautiful things. When you're broadly diversified, the lesson here is that you were diversified. When we look at NVIDIA, most of us probably didn't even know who NVIDIA was 5 years ago, but yet you owned it. It was in the S&P 500, and here it is today, voila, 6% of your S&P 500 holdings. So by being diversified, the lesson is we were diversified. We were outside of our core market, outside of what we knew. We invested outside of what we knew, and what did we do? We benefited tremendously from that.
Yeah, and it's like the old sage says, I mean, buy and hold is important, but if you would have bought and held some of those stocks versus just being broadly diversified in the S&P, you probably would have underperformed the market over the last 30 years.
Yeah, substantially, right?
Because
we know that all that performance is coming from a few stocks. You would have collected some nice dividends along the way, but that would have been probably about it.
Sure. Well, let's shift gears from boring, technology stocks to really exciting asset classes like bonds. It's about as exciting as probably this yield curve you're looking at, but tell us a little bit of what's going on in the bond market and why we should still be invested in bonds.
Yeah. So what we're looking at here, Brandon, yes, the exciting yield curve here. So I'm just going to point out what it is you're looking at, just so you can get some sort of sense. The sort of dark line is the most recent yield curve. And then the yellow one is the end of the year. So you can see interest rates haven't moved much sort of in the first month of the year. But what you're looking at, this other line, is where the yield curve was a year ago. And what the yield curve represents is that we just know that there's not one interest rate. There's interest rates along a spectrum. So, cash earns a different interest rate than maybe something like a 2-year treasury versus a 10-year treasury versus a 20-year treasury. So there's a lot of different interest rates along the way. And what we've seen here is, and depending on what you're doing, if you just got money sitting in a bank account or a cash account, you're really concerned with this over here on the left side, the current yield and what the Fed does, and that's going to have a big impact. As you move out, this is where we're concerned. So we're starting the year at about 4.5% on the 10-year Treasury, which is a nice tailwind, because for a long time, since 2008, we've had really, really low interest rates, and it's really been sort of a headwind to getting returns from bonds. And I talk a lot about this, and have for a long time, that bonds are really in their portfolio as a risk mitigator. They're there in case stocks go down and the economy does worse, and then you have the safety net of sort of bonds to support you. But for the first time in a long time, we're looking at 4.5% on the 10-year, 4%, 4 to 4.5% on the shorter end of the curve. And and even though inflation's sort of at elevated levels compared to where it's been more recently over the last decade or so, it's still higher than that. So for the first time in a long time, we're getting actual returns over and above inflation from treasuries, which is a really nice, welcome place to be. And it's a very nice backstop to, things going, awry. And I think if we told you 3 or 4 years ago that you could lock in 4.5% from 10 years from a treasury, you just said, take it, I'll take it, I'll sign up. Now we had to endure some pain to get there, but we're there now. So
Right.
So we've endured the pain. So let's actually benefit from these higher yields.
Yeah, and we're getting better yields, and it was definitely more difficult to talk about bonds probably 3 or 4 years ago, because there was zero yield because of the pandemic. But we were still encouraging folks to invest into bonds, and I think primarily because of safety, right?
Yeah, absolutely. That's what its job is. And so, if what happens is in a downward market trend, you get this flight to safety, and you need to know that you've got something there that's actually can go up in value if stocks are going down. And how do you offset something that might go down as much as 30, 40, 50% in over a short period of time? You want to make sure you've got something there. And so that's why we have that, especially if you're in that distribution phase or getting a year or two away from that. You really want to make sure you've got that safety net.
Yeah, and I always talk a little bit about the Great Recession. No one knew that was coming, but our long-term Treasury position really saved us. Give a little background on that, Tim.
Yeah, so in 2008, actually, I just had joined our predecessor firm and joined Brandon and John at that time. And at the beginning of 2008, and one of the first things we did is we really looked at how we were structured on the fixed income side and say, hey, we own bonds for safety. If we want return, let's just own more stocks. And we ended up with some long treasuries in there. And the long term, the 30-year Treasury did over 30% that year up. And well, we didn't put all of the bonds in the 30-year Treasury, unfortunately. But was able to actually give you some ballast, because if you remember in 2008, things like corporate bonds, high yield bonds, even municipal bonds had negative returns that year. So it was really those really long-term dated, really safe treasuries that actually provided the most cushion. And cash, as nice as it was, it didn't go down. It also didn't go up in that time frames too. So
Sure.
the bonds with the yields that they have today give us a little bit more play, and probably going to give us a little bit more cushion than we're used to.
Absolutely. And right here we have long-term rates increased after a rate cut. We had 3 rate cuts in 2024, a big one back in August of 50 basis points, 2 quarter basis points cut in November and December. Yet looking at this graph, interest rates actually went up.
Right.
Aren't they supposed to go down?
Yeah, this is the 10-year, right? So keep in mind, 2 different types of interest rates. So yeah, the expectation would be that if the Fed lowers the short-term rate, your expectation would be that maybe long-term rates don't go down as much, but that they kind of go down in sympathy or in in lockstep maybe with what's happening on the Fed side. But instead, we saw really the opposite, which was we saw the 10-year yield rise, and that was for a couple of reasons. One, when they made that initial half point cut, there were some weak jobs numbers, which were followed up almost immediately with stronger jobs numbers. And so this thought that maybe we need to push this economy forward ahead a little bit with lower rates, and that maybe inflation was more subdued. I think within a very short period of time, the market reacted and said, we're actually more worried about inflation than economic growth. And so with that, the inflation expectations move higher. Typically what you're seeing is the longer end of the yield curve, the 10-year treasury start to pick up, raise rates and lower prices in anticipation of that. And so that's really where you saw that bond pull back after that happened. And then coincidentally, there started to be a little bit more focus and concern on the debt and the deficit levels, and which impact financing for the government. And yeah, we can probably talk a little bit more about that too, Brand.
Yeah, we can definitely talk about that. And just looking at from a Main Street perspective, obviously, there's a lot of people that have been putting off purchasing homes or buying new homes because interest rates are so high in hopes that they're going to go down. I know we went to the Dynasty Investment Forum, had some of the brightest minds within the fixed income area. And, what was their general consensus that you heard?
Yeah, that they're not going to be coming down here.
Yeah.
We got to get used to mortgage rates, probably 6 or north of that for some time. The expectation, like the Fed coming down, lowering rates. I think there's an expectation maybe 2 more Fed cuts this year, but it's not going to be anything too substantial. When we're looking out here, though, one of the like I said, the headwinds here is we're looking at the total U.S. debt level. There's the kind of the goldish yellow line here, the total debt. The net debt is often what people are looking at. That's net of what the government owes itself. So, sort of double counting if you count what they owe they're paying to the other parts of the government. But nonetheless, I mean, either number, it's pretty significant, and it's come up quite a bit since the Great Recession, right? We had a lot of stimulus at the Great Recession. It kind of flattened out for a while, and then COVID hit, and we had another round of stimulus, and it's pushed our debt levels up to pretty high levels. And the concern that the bond market has is not that the government is going to default. Nobody's really worried at all about like a Greece sort of crisis that we had after 2008. It's much more about just the sheer volume of debt that the government has to finance and refinance on an ongoing basis. And it's not just the U.S., right? This is more of a global thing as well. The debt levels for a lot of countries are at historic highs or near historic highs. And so with that, what will happen is like, okay, there's only so many of us that want to buy so many U.S. treasuries, right? So how would the government entice us to buy more? Well, they'd have to raise rates to entice us to do that. And that's really the concern that the bond market has right now. And that's why I think you're seeing that longer end of the yield curve hold up so high right now, is that it still hasn't digested how the government is going to be refinancing its debt 5 years from now and 10 years from now, how much debt they're going to have to issue and what interest rates will have to be to make that happen. And I think that's really why you're going to see a lot of stickiness on that long end and an inability for that to come down too dramatically, barring probably a recession.
So looking at the debt, I mean, I know everyone discussed it, and we're looking at budget deficits. How is that going to impact the economy short term and possibly long term?
Yeah, so the reality is, it won't probably have much short term impact if we don't do anything about it. I mean, we've seen how all of this stimulus, whether it's from the global financial crisis or from COVID, stimulates the economy. It actually does generate some growth, but at this cost, right? And at some point, this level of debt becomes unsustainable, or level of deficits become unsustainable. And so one of the things you're looking at right now here is this is sort of the year over year, right? This accumulation of all these annual deficits, which leads to that large combined debt level. And historically, we've been right around about 4% on the the deficits of 4% of GDP of the size of our economy, and so that's very manageable. It's not anything outlandish, and you typically exceed that when there's periods of like economic crisis or war, which you've seen recently. I think the challenge right now is, do we have a path for this number, this deficit number, to come down or come down substantially? And the challenges we have are we don't have a lot of places to go look either for more money or to cut spending. I know there's a lot of political things going on right now on that front, but the reality is, like that level of debt at these higher interest rate levels, there's a certain amount of interest government has to pay. There's no getting around that. There's no legislating around that. That's just going to have to happen. And then we've got a lot of things that we spend money on that are going to be really tough to shrink spending significantly enough to get this down. The other is you raise taxes, and the other is that you grow out of this, meaning you can keep the same level of debt and the same level of deficits, but if the economy is 20% larger, this number as a percentage of the economy is smaller. So you can just grow GDP. I think the most likely, historically, how we work our way out of this is we grow GDP. And you see, like when we had the budget surpluses in the late 90s, that was really what was happening. We had the economy grew, and we grew to the point where our taxation, without even raising rates, was high enough to offset, our spending at those levels. But It's still tougher in a higher inflationary environment, to be honest with you, to be able to consistently do that.
Yeah, it's a tough task. I'm glad I'm not in charge of it. We've heard this word probably too many times over the last 3 weeks, tariffs. Obviously there was a 25% tariff that was put on Mexico and Canada. It was resolved very quickly. We have a 10% extra tariff on China right now. But if we do have future tariffs or even the present tariff that we have on China, how do you think that may impact economic growth?
Yeah, well, a tariff is, it's a tax in one way or another. So unless it's offset by a tax reduction somewhere else, it's probably going to have a net ding on the overall economy. So this was just the Tax Foundation coming out and their initial numbers. You can, we can always argue with how the people calculate these numbers, but I mean, the reality is we know there's going to be reduced economic growth from this, right? It's just got to be a headwind. If the tariff comes out, it either means that the consumer has to consume less, and that's either the U.S. consumer or the foreign consumer if the tariff is on U.S. goods leaving the country and going into another country, or it's going to be borne by the companies. And so, whether it's us as a consumer paying more or us as business owners, shareholders in the S&P 500 companies and all of these other ways that we participate in the overall economy, one way or another will probably bear that price. So, they're just showing, the net effect of these tariffs would be about 118 billion of loss, 106 billion of gain to the Treasury, right? Money's going somewhere, it's going back to Treasury. Now the question is, does 106 billion move the needle on those deficits that we talked about? And the reality is probably not a lot. So that I think that's one of the challenges. So it's not going to be offsetting or be able to reduce the deficit in any sort of substantial way, and sort of the net negative effect. But I think most of the numbers I'm seeing are, and again, I think I'm honestly a little bit less worried about the worst case scenario, which would be all these tariffs go into place. There's tariffs in Europe, and then there's sort of the retaliatory tariffs back on U.S. goods and services. That's that full-out trade war that I think that would be sort of the worst case scenario. I think these things are going to be, I think we've heard the word targeted, but I think they're going to be negotiated piecemeal, probably a little less impactful than the sort of doomsday or worst case scenario of them all getting fully implemented, sort of as a starting point. I think we'll end up quite a ways off of that. I think the bigger concern for me, just when I'm looking at this stuff, and it's not probably as much of a 2025 problem, it's that companies need, they value certainty. And one of the things, this is very disruptive of, the supply chain. So, where do you build factories? Where do you hire people? Where are your distribution centers? How do you handle these things. So, because we're used to getting things instantly, right? I order something on Amazon, I expect it on my porch within 3 hours. And so I think the challenge for us is going to, or challenge for businesses is really going to be more around those aspects of how do you re-engineer your business, especially if you don't know that any of these are really going to be permanent.
Right.
Is this going to be long-term policy of the U.S. or are these going to be negotiated one-time things to get some other concessions? And the way I'm looking at it right now is I'm going
Right.
down that path mostly.
Yeah. Definitely. CEOs don't like to pivot too often. They like to look at their strategy
No.
go all the way to fruition. So good point. Um, okay, so we have asset class annual returns. I call it the periodic table of investing. I had one of my clients call it a quilt at one point in time. It's just how total assets have performed in relation to each other over the last 15 years. And, looking at this chart, Tim, just give an explanation of what investors should be getting from it.
Yeah, lots of colors and try to find the patterns in here. I think a lot of people do. They try to find those patterns in there. So what we're looking at here is this is just basically everything you can invest in. The green is the large cap US, the S&P 500 small cap. We just talked about that. The white boxes is the one I really want people to pay attention to. These white boxes that run across, this is asset allocation. This is sort of a representation of what approximately a 60-40 portfolio or 60% stock, diversified stock, and 40% bond portfolio might look like. This even includes some things like high yield and commodities and stuff in it as well. So it's really broadly diversified. But what you can see is you're kind of always in the middle if you can get that asset allocation right. And again, if you can get it more right than sort of just a generic benchmark, then even better. But the reality is, I think for most people, if you could get 13% flat in 2011, 12, 4, 15, 5, minus 2, 8, 14, minus 6, 19, 10, 13, a lot of people would be pretty excited about making sure that they can maintain that. That's what supports people in retirement and making sure that we're just not missing the mark too much. Maintain that diversification, make sure that we've got every opportunity available to us, because again, we don't know where the next NVIDIA is going to be. Is it going to be based in the U.S.? Is it a small cap stock today? Don't know.
Yeah.
Is it emerging markets?
Yeah, absolutely. And when I look at this, it's tough because I don't have 2008. We've moved out of it a couple of years, and if you look at the last 15 years, it was a no-brainer. You had all your money in the S&P 500, but we also have to remember the S&P 500 was down almost 40% in 2008. And if you are retired and you're taking out 5% of your portfolio, most average 60-40s were down 23, 24%. Having a third of your portfolio be gone at the end of the year is a tough pill to swallow. And so that's something just to keep in mind. I tend to show what has happened, in 2017 and 21 and 22, because if you look at the number one performer in all of those years, they were actually the worst performer the following year. So just something to take. Sometimes today's winners are tomorrow's losers. So just going back to the concentration that we have in all of the technology stocks, you definitely need to be careful out there, depending on what your risk tolerance is. So, well, Tim, I think that's a conclusion, of our market outlook. Anything you wanted to end on as far as
Yeah,
advice
well,
to
I was
give
going to
everybody?
just see, I've got a few Q&As. So
Okay,
Brandon promised that we would hit these
I
things.
did.
I will do our darndest to do this in a compliant way and a thoughtful way. And let's see. Well, some of us are saying that we can we can be heard. One of the questions was about real estate. Does not look good. What's going on here? It's funny for real estate right now. Real estate's been hurt on a number of fronts, right? Like office real estate with COVID and just people not being in the office, just sort of demand for office space has been down a long time. But the bigger thing has been the rise in rates and the cost to finance real estate, right? So when when you were able to finance real estate at, it's extremely low single digit rates, that was one thing. Right now, you're financing your real estate high single digits, maybe. And so that makes that cost higher, and it makes the property ultimately less profitable and therefore less valuable. And that's really what we've seen. I think we're getting to the point on real estate, though, that we've started to digest a lot of the higher rates. We've become accustomed, and we haven't fully digested. Let me just be very clear. There's going to be a lot of debt that has to be refinanced from still these really low rates into this higher rate environment. But by and large, we're starting to digest some of that. And I think some of the demand is coming back even in office space. I can tell you, as we've looked around, I can tell you just driving into work each day, every day, there's more and more people coming back to the office. So on the office side of things, I'm actually feeling a little bit more optimistic. I don't know that it's like my go-to place right now. So again, real estate, it's a part of the portfolio. I think we're looking at a little bit more thoughtfully. It's something that we've really kind of removed from our portfolios for the last few years. And I think we'll be looking at how do we selectively make sure that's part of a client's portfolio going forward. Maybe it's 25 or 26 and beyond. But again, it's usually a sort of a nominal or a really small piece around the edges. Somebody asked about the international and the impact of DeepSeek on non-U.S. AI efforts on U.S. tech, and how do we plan to protect the portfolio from those events? So I think we talked a little bit about this, but it's my point exactly. I mean, DeepSeek, there's nothing you can do directly there. I mean, it's possible at some time as an emerging market investor with a portion allocated to China that DeepSeek could end up being in sort of in those emerging market indices. Like one of the biggest parts of the emerging market indices today are like the Taiwanese semiconductor space. So that's where you see a lot of strength there. But again, we don't know where the next winners are necessarily going to be. And perhaps we may be in a bit of an economic, I think we're constantly in an economic race with China. But it's, they do benefit. If they're investors in the U.S., they can benefit from our innovation. And if we're allowed to, or if it's prudent to invest in China, then and they're winners, they're tech winners, then that'll be great too. We don't know if that's going to be always possible. And that's always one of the risks with emerging markets. So a little bit challenging to get everywhere in the emerging market space, but certainly. Again, another just reason why we want to stay as diversified as we possibly can be.
And one thing I wanted to add there, Tim, is what you also want to always do is make sure that your financial plan is driving your risk. So a lot of people have done extremely well over the last 2 to 3 years. They're in a well-funded position. If you are concerned about what risk could be out there, then it may make sense, for your situation to take some chips off the table or maybe reduce your risk. So that's another thing our advisors spend a lot of time with our clients doing.
Yeah. Yeah, and again, it's always going to come back to that risk level. That's what we've got to get right. I got a few more questions here on sort of the pivots out of the Mag 7. Or how do we do this? Given the big run up the last few years, where might you pivot to for more conservative investors? The easiest case there is, and again, it's a lot easier today to be a little bit more conservative than you would have been traditionally. It's really hard to be less than 60% or even 50% equity when the interest rates were so low. You actually have a few more options, I think, for a more conservative investor. If you wanted to be a little bit more conservative, you could get down to 40% stocks. That naturally reduces it. But I think it's more broadly, it's just making sure that you've got the broader diversification, that you're including the other asset classes like the foreign, like the small cap. And that also, one of the things that we're doing on our end is really refocusing and making sure we're not over allocated to just growth in general, and that we're picking up that value side. Brandon talked about it too with those companies. When we look back at all these blue chip companies that were in the index in '94, or that were the top holdings in 94, making sure that we still have companies that are just driving consistent earnings. And I think in paying dividends, I think those would be the bigger things for us on that front. Guesses on inflation in 2025 and 2026. I don't see any. I guess I'm going to be in the camp that I don't see inflation I feel like 3 is going to be the new normal rather than 2 as we go forward, which is historically not a bad rate or not a bad spot to be. I don't see anything deflationary coming or disinflationary happening right now. If the job market weakens enough, possibly you could see a lower inflation level. I feel like if inflation gets a little bit lower, it's going to spur the Fed to cut rates more, which in turn might be more inflationary. So we'll have to see. You know, there's always a lag between those types of changes that the Fed makes and, you know, what actually happens and takes place in the real economy. Trying to think. Questions about dogs of the Dow. Investment strategy outdated, no longer able to identify and underscore value-based investing focus. Yeah, I think the Dow has struggled just as an index to maintain relevance. You know, it's one of the things I think I love about the S&P 500. It's not trying too hard. It just says who are the 500 biggest companies. Let's own them, and let's proportionately rank. You know, invest in them based on the size of those companies. And you don't ever have to worry about hitting or missing. You're going to be, you know, to our earlier points, you're always there. Dow, it's always a challenge because there's only 30 companies, and the dogs of the Dow is sort of the worst oriented. And we've been in a very momentum-based market, momentum being the winners continue to win, the losers kind of continue to lose. Those things happen for periods of time. They don't happen indefinitely though. So, you know, maybe a comeback time for the dogs of the Dow, you know, what we would call being a contrarian investor or mean reversion. There's a lot of ways to say it, but there's always the risk that what did well last year is not going to be doing the best the next year. In this, you know, we're looking at this chart that explains that, right? That 38% in 2017 from emerging markets, -14 the next year. Those are the things that you've really got to look out for. Large cap, even as much as we love it, it's only been the top performer, you know, what, 3 years out of the last 15? You know, so it's been strong, but there's always a lot of times been something stronger over that course of time. So I know we probably didn't hit everything, folks, but you know, please reach out to our advisors. Ping them with questions. You can respond to the invite. It'll come to me. We'll get you some answers. And I really appreciate everybody jumping on. We're excited for this year ahead. You guys have all been great. Thank you for joining us on our journey into independence. We've loved this last 16 months now, Brandon. Is that it? Or 17?
Yeah.
It's getting up there. But if you love what we're doing, please let other people know. We are open for business and open for referrals. Love that you guys love us, and we love you too. And we're doing this for you guys. I take a lot of pride in the fact that we've got over 2,000 retirees that we get to help make their dreams come true in retirement. So.
Yeah, that's great, Tim. And yeah, and if you do have any additional questions or need any assistance on some of the information we covered, you know, please reach out to your advisor. Be happy to kind of review the portfolio, rehash what Tim and I said. And thank you for attending, and I hope everybody has a great day. Thanks.